Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good. How are you doing?
Going well. How was your vacation, Derek?
It was good, yeah. Despite the fact that one of our little ones got sick and lack of sleep the first 2 nights because of it, but we had fun. It was good to get away. We went out to Door County, Wisconsin, so that was beautiful. Weather was perfect.
Yeah.
What y'all do over there?
It was a peak cherry season, so we got to, reap the rewards of everybody's harvest there. There's just fields and fields of cherry trees, which is a nice break from the Midwest where it's normally corn and soybeans.
Mm-hmm. Yeah, that's a feast for the kids then, huh?
Yeah, it's fun. It's fun. I enjoyed it there.
Yeah, it's a beautiful area.
Yes, it is. Well, guys, this week we're talking about expanding your IBC system. And we're referring to page 48 of Nelson Nash's book, Becoming Your Own Banker. And as we've been working our way through this book, this is the one area that really confuses me and stumps me from time to time. And one of the interesting quotes from this section, Nelson describes that premiums and your income should match at some point. And guys, this is, like I say, one of the confusing things about this book. What do you think of this statement here? Is it possible? Is it recommended? How do you do it even? What are your guys' thoughts?
And when I first read that, I thought, man, this guy's a salesman and he's just trying to start as high as possible. And I'm coming in super low and maybe we'll meet somewhere in the middle and still have a really big policy to start off with. That's what I figured his sales tactic was. And, I was pretty skeptical when I first read it anyway. So it's hard for me to grasp too, Derek. It's not definitely, it's not something you can do from the start. It takes time. And Nelson is known to have talked about just how he built a system and expanded his system. And I think he had 49 policies by the end of his life. And man, the first few times I read that, I just thought impossible, simply impossible. And starting to understand it, starting to imagine, and that's one of Nelson's main things he talks about in the beginning of the book, right? We already talked through imagination and understanding that this is possible and understanding what that could potentially look like. Rob, I'm curious what your just initial reaction was.
I guess I was initially really excited. It seemed actually when I first read that, I was like, oh yeah, makes total sense. I'll just cycle all of my cash like that comes from my job. I was run it right through my policies. But then I started thinking about it more. I was like, well, my policies have premiums. Like you got to pay the premiums. So you have to have free cash flow to pay the premiums. And then my euphoria started to drop. It's like, okay, well, I can't do that immediately. So I'll just start with, look at my free cash flow. Look, kind of the way I was looking at it is like, well, the money I have pooling in a bank, at least I can start there and then start looking for opportunities to add more policies and to cycle more cash flow through policies. But John, I was immediately like, oh, I can do this. This makes total sense. And then I started thinking about it longer. Like, I don't know how one can do that. So I'm kind of like down to earth again. But still doing it in a big way, paying a lot of premium. But I don't know. This is more of a question. Has anyone given you a definitive answer of how this is possible? Like, what did he mean? I've heard people say that meant just over time, the amount of income you're putting into your policies will kind of equal your income 10 years ago or something like that. I don't know. I never really got a really great answer on this one.
Well, I even heard on another IBC podcast, honestly, I can't remember which one it was, that they asked Nelson, like, what's the deal with this page? What's the deal with this statement you made? He's like, you're right. I should have clarified. Your premium should exceed your income. Rather than coming down.
Uh,
He stepped it up, and I think he rationalized that by saying, at a certain point your dividends are just massive, like compared to your
yeah.
cumulative play and the annual premium. So that's where he's saying, I think it should even exceed. And
Wow.
people are just maybe limited, maybe we are, to a certain extent by what we can imagine is possible. But I do think it's very important to just understand and step back his philosophy and Nelson's understanding of the banking function. In any case, like we can understand that these specially designed dividend paying whole life policies are the best place to store our money and are the best place to keep our money flowing. And then eventually finance the things of life, take advantage of, fun opportunities out there, be it real estate, business, startups, whatever it may be. We can still understand to a certain extent that all of our dollars should be stored in a bank in one form or another. And what better bank than these perfectly, designed whole life policies to house, grow, and access all those dollars in a tax-free manner.
Yeah, Derek, I kind of liked your thought of how you think that it could. Do you want to just kind of go into detail how you think that could, with the dividend kind of conversation, like how that actually could technically happen?
Yeah, so I suppose there comes a point in time, maybe 10 or 15 years into your policy, where you've recaptured the debt that you recaptured the interest that you're paying to third-party lenders. Even you feasibly could refinance your mortgage and finance it through your IBC policy. But what about those things that we generally don't think of as financing, like your groceries or your utility bills? How do you get that income into your policy? And then, you're taking out a policy loan, so you're getting charged interest from the insurance company. How does that work? Well, my thought process is, potentially Nelson may be referring to, let's say you take out $75,000 for your cost of living. That's how much you spend each year. Proof, it's gone. It's just what it costs to live. You took that out in the beginning of the year to pay off the things that you needed in life. And the interest that you were being charged at, let's just say 5%, you could utilize or switch your dividend allocation so that the dividend was paying off or paying for the interest expense that the insurance company is charging. Now, of course, there's a large trade-off there. And I don't necessarily know if I recommend that yet. I think I need to probably do a little bit more research there. But the trade-off is now your dividends aren't purchasing additional insurance, which is going to at least slow down or potentially interrupt the uninterrupted compound growth, which is why so many people are drawn to this strategy. So by doing it that way, it's, you're kind of placing a little bit of a drawback or hindrance on the policy that otherwise wouldn't have been there, which is why this section just makes me scratch my head and think about, how does this work? But I think more broadly speaking, something that could be useful for our listeners is determining when we expand our system and how do we do it.
Mm-hmm.
I have just a few thoughts that I'll share, and then I'll turn the mic over to you guys. Me personally, my goal is to try to increase my income as great and as quickly as possible before age 35. And you might be asking, well, why would I want to do that? Well, what I'm concerned about is increasing how much death benefit coverage I have as for protection to my family. And with insurance, life insurance companies, they have brackets or tiers. There's a certain factor, 30 to 35 times your gross income based on your age between 18 and 35. And so that's why I'm trying to increase my income before age 35 as much as I can, because that factor is the greatest amount that it will ever be. The older I get, that multiplication factor will be reduced over time. And so I will have to make much more income later on in life to equal out the same amount of death benefit coverage that I could before age 35, just because I'm taking advantage of that multiplication factor.
And the idea there is like the idea of maximizing a human life value.
Correct. Yeah, that's what I'm trying to do, is determine, what's the greatest amount of income I can earn or show, multiply it by the multiplication factor based on my age, and then that will equal the total amount of death benefit that the insurance company will allow me to purchase on me personally.
Yeah, and I think that's a good point. Our listeners might not be aware that there is a limit to what the insurance company will insure you at. It's a ratio. In fact, one of the simple ways is your age and your income, and that factor that Derek was talking about. Because there's a limit. Like if your income is $100,000 a year times 35, that's 3.5 million. That's the most you could get insured for at that point in your life.
Right.
So, and then when it hits that next tier, if you're making $110,000, well, now it just drops to 2.5, or so you can't get any more potentially at that point because you've already maxed your human life value. So it's just something to think about. It's just, I don't know if people are aware that there is a cap to what insurance companies will insure you for.
And there's also a cap. Sorry, John, let me just jump in quick. There's also a cap as to how much premium the insurance company will allow you to pay.
Right.
Because they know, well, hey, we don't want to put an unnecessary burden on your income. And of course, the more income you make, the more that they will allow you as a percentage of your income to pay towards premium. But one insurance company will not allow you to pay 100% of your income as premium.
Right. The
only way to do that is to spread across your insurable interest to other family members or business partners, people that, like I say, you have an insurable interest in. You would be the owner and the payer of those life insurance contracts, but it's on somebody else's human life value. And so those are, important factors to consider. Is an insurance company isn't going to let you put 100% of your income on one individual person. You're going to have to spread that out over many people.
Yeah, so we're talking about the how when we're talking about expanding our system. And to dig a little bit deeper, I think y'all would agree with me, and feel free to disagree, that the mechanism is through a convertible term policy.
Mm-hmm.
And as your income, and then we'll talk about the when, as your income increases, ideally your expenses don't increase at the same rate. And you can then convert some of that death benefit that you just purchased in a term policy into permanent policies, where you can then store your cash flow and access it and have it, corralled in your policy in a safe, guaranteed, controlled fashion, and then keep building your policies that way. And an advantage there, just like Derek was saying, they do financial underwriting. They make sure you're not going to pay 100% of your income into premium the first year. But on these convertible terms, you don't go through medical underwriting, and you don't even go through financial underwriting. You just convert it to whatever design you want and build your system as you're able, because we always want to do what's manageable and what's meaningful. And that's kind of the how. What would you say, Rob, is the when? Have you expanded your system, and what would that look like for you?
That's actually a very timely question, John. As a matter of fact, I'm about to expand our family system.
I actually didn't know that, by the way.
Yeah, that was a perfect question. I'm going to be doing it I'm going to be starting within maybe a month. I'm going to start submitting the app process. We're going to add another policy. So we already have, we basically, 6 years ago, started a big policy with pretty much almost all of our free cash flow. And we put all of it into a policy. So fast forward, 6 years, we have enough extra cash flow that is kind of sitting there, not doing anything. It's in a bank account. And it's like, so this is like the time is right for us to expand our system. You know, my income has increased, my wife's income has increased. And so this is a good time for us to expand the system. So we're going to set up another policy to fund that extra cash flow into a new policy to expand our system further. And so that to me is kind of what I look at as the natural progression of how it works in a family. Solution to all of life's problems is high premium. The more premium you can put in, the bigger and better your system is. It's just, I mean, it's just a fact. But at certain points in your life, you only have so much you can put in, right? So you just have to just keep waiting and you know, getting, you know, your job, you get raises or whatever, life happens, and you get to that point where you have more free cash flow. That's like the perfect natural opportunity to expand your system. And so I'm not quite sure how I can ever get to 100% unless I do what I like what Derek was saying, is at some point our dividends might be so good that we can just put it all in there. I don't know. We have to run those numbers someday, but I think that's more of the natural progression for families is you get more income, then you add your more policies on like that. Oh, and I was going to say one more thought too. So we talked about human life value and how it maxes out. Like, so let's say it's maxed out at 3.5 million. The cool thing about it is you might be maxed out at 3.5. At that point in your life, the insurance company will only issue you up to 3.5 million. But the way we design policies is that it will the paid up additions will continue to always be purchasing more death benefit. So you'll start to far exceed the death benefit that the insurance companies were willing to put on you. So if you work with us or any IBC practitioner, design a policy correctly, you will get more death benefit than the insurance companies would insure you for by doing it through the infinite banking, you know, process.
Yeah, we expanded our system, man, a couple of years ago when my income changed drastically, which is always nice when that happens. But the other thought of, you know, thinking about expanding your system, you know, even if I have enough free cash flow, what do you do with it? Well, first of all, I want to pay my PUAs for that given year. Secondly, maybe pay off policy loans, existing policy loans, if I have cash flow available. Third, I could look at expanding a system on myself if my income allows for it and I haven't maxed out my human life value. But I may also want to just start a new policy on another family member, even though I may have more human life value to go. Mm-hmm. And the reason for that is just because, well, man, I want coverage on my spouse and my kids. So even though I'm the primary breadwinner, I'm still want to insure my loved ones because, you know, God forbid, if something happens to them, I want there to be that death benefit coverage there to help in that time of need. So there's a lot of different factors, you know, when you think about what I've got free cash flow available, what do I do with it? Well, it's going to depend. And we haven't utilized the convertible term feature yet. And I probably won't for maybe another decade, even just because I want to expand my system either by adding more policies on myself, get that maximum human life value, and also get coverage on my loved ones.
You know, and just a little plug for that, you know, so looking at expanding our system, I wish when I got my first policy, my big IBC policy 6 years ago, I knew I wanted an IBC policy, and he actually went through an insurance company that we all work with. But one thing he didn't do that I wish he would have done was encourage me to get a term policy, a convertible term policy at the same time. Because some insurance companies, you can kind of bake the term policy within the whole life policy. Other insurance companies, you get it as on the side. And the company that I worked with then, you more get them on the side. And I wish I would have just because when you're younger, you can lock in on these 10 or 20 or 30-year term policies, and they're so inexpensive. If it's convertible term, that gives you all of this, all of this death benefit that you can convert into whole life without having to go through underwriting. And I wish we would have done that 6 years ago. And that's actually something I encourage everyone who's thinking about getting a policy. Make sure you have enough term in there that you can then convert it. Think, like Nelson says, think long term. think about your next policy. Make sure you have enough term in there that you can convert. Lock your term in now when it's inexpensive, so you can convert it into your next whole life policy so you can expand your system.
Yeah, and I'll just add to what Derek was just saying that, it is nice when you get those pay raises, when you have a change in occupation or career or whatever. I was just talking to a friend yesterday, I think. He had been working for a couple weeks at a new job, hated it, was already applying and interviewing within those first few weeks, and called me. He's like, I got the other job. The pay is almost double. The benefits XYZ. It's just amazing. Like I can't believe I got this job. It's amazing. And one of the first questions I said is, well, so are your expenses gonna double as well, or so he already knows IBC, and he's looking at building some policies right now too. So it's just really great for him to be able to have that extra cushion to then fund bigger policies and really, really accentuate, your opportunities, your finance the things of life, rather than spend it on a, golf club set or whatever else people spend their money on. What better way to build your legacy, think long term and build assets, with those pay increases rather than, something that'll probably be obsolete in the next 2 years.
So what do you recall which law that he'd be breaking?
Parkinson's.
That's right.
Yeah, definitely. It plays in.
Mm-hmm.
And just by the nature of being able to conquer that, you're winning. You're ahead of most people.
Isn't that? Yeah. Isn't that the truth, John?
Oh, definitely.
If you can just defeat Parkinson's law, like expenses rise to your level of income. If you can just make your expenses rise, lag income. Yeah. Huge.
You can even rise your expenses a little bit, Nobody's here to tell you that you should do beans and rice and drive a 1960s beater. Like, you can still enjoy your life and build something lasting. But we're just saying, conquer Parkinson's law, understand like where your cash flow is going. If your income increases by 10%, you can increase your expenses 2 or 3 or whatever, just right. You're going to be on a treadmill if you continue to match those, though.
Well, guys, this was really helpful. I think our listeners will get some good value out of this episode, and just for them, food for thought of when do you start a policy, when do you expand your system. Just remember to listen back and hear the advice of us, and just say, hey, it depends, but there are a lot of different factors that you could consider. In the next couple episodes here, guys, we're going to be talking about my favorite section of the book, equipment financing. And so I hope everyone else will be joining us in those future episodes as to how do we utilize this in practice. We're going to dig into some modern day examples as well of how you could do this for yourself personally and also for your business. So I hope you join us in our next episode, and we'll see you then.
See you guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.